Welcome to another episode of Map Your Money. I'm one of your hosts, Arish, Nurani, wealth advisor, certified financial planner here at Benedetti Gooser and Associates.
Hey, and my name is Jeff Cohn. I'm the Chief Investment Officer of BGA Wealth and Beam Wealth Advisors, and also a chartered financial analyst.
Great to have you on, Jeff. And like always, we start every episode with an icebreaker. And so I believe this episode should be coming out right in the thick of March Madness. If you're watching this on YouTube, you see Madness right next to my head. And one of the most fun times in the sports world. Are you a big college basketball fan, Jeff?
Yeah, I don't watch college basketball that much, but I love watching it when I do watch it. It's kind of one of those weird things. Like I never seem to turn it on TV, but anytime it's on, I'm like, oh, wow, look at them running this 2-3 zone. And they better work that ball around real quick. But I played basketball in high school. I started my senior year. It wasn't all that good, but it was one of my favorite sports growing up. So I still enjoy watching it.
Yeah, basketball is a fun sport to play. And I'm not a huge college basketball fan. I couldn't tell you much about anything about this season. But as soon as the tournament starts, I'll be fully locked in. The March Madness is something different. I think it's the best playoffs in all of both amateur and professional sports that's out there. It's just so fun.
I mean, it's intense, right? And I think the funnest thing about watching sports is that the outcome is uncertain. And I think March Madness is one of those tournaments that an upset can happen at any time, any part of the bracket, any team. It's totally unpredictable. That's why you watch sports.
Definitely. I'm going to have an eye on the women's tournament as well with Caitlin Clark. It hadn't been something I'd ever really paid too much attention to, but the last 2 years, she's just so fun to watch and is truly a baller. So she's done a lot for the sport and definitely going to continue to see growth there.
Yeah. Yeah. Hey, a lot of talent over there in women's college basketball too. And Iowa Hawkeyes, here in Columbus, Ohio, they're not too much big fans of Iowa. I think they're all pulling for Ohio
Big 10
State.
rival.
Me being from Arkansas State, not usually in the tournament. Whenever we're in there, we're typically out first round. But the Razorbacks, they have a shot.
Anything can happen though,
Yeah, I don't think the Razorbacks have won it since 1992 when I was born. So maybe they can turn it around.
Okay. Well, sounds good. Hopefully it's an exciting tournament. I'm sure it will and never really disappoints. But let's get into the finance bulk of our podcast.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and help individuals create the roadmap for their financial future. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the content was pre-recorded.
All right, so we have a bunch of different topics and ideas that we want to cover today. We have an internal document that we might reference a couple times. I know we referenced it 2 episodes ago. But if we ever reference a chart or a graph and you're listening on podcast form, whether it's Apple, Spotify, whatever it might be, we're going to try our best to explain the graph or visual. But if you want to see the graph or visual, you can watch it on YouTube, see our slightly beautiful faces, but more so look at this chart. And to find us on YouTube, you can look up Beam Wealth Advisors or Benedetti Gooser and Associates, and you'll see the video on each of those channels. So, Jeff, I believe it was called like the talking stick back in pre-K or whatever. So I'm throwing you the talking stick, and you can pick our first topic.
Oh, wow. Okay. Culturally, that's just a little removed for me. In Arkansas, we always raise our hand, Hey, so I think we have a lot of good topics to cover today. One that you put on here that I really like is this conversation that I have frequently with not just clients, but also advisors on whether to pick an active versus a passive manager. And so something I threw in this document is a bunch of different ETFs that track benchmarks or underlying indices that managers will use to compare their performance. And I threw up the 3, 5, 10, and 15-year return rank of these ETFs, right? And so basically, if these ETFs are ranking well against their category, that means the active managers within their category are underperforming, right? This is the benchmark. So if the benchmark is beating most of the category, then most of the managers are not doing well. And so I threw this on here just to kind of think about, hey, what are the areas where active managers do really well? And what are some of the areas where the passive benchmarks are actually outperforming? I think it's probably not going to be too surprising to you when you look at this list the two that really stand out as high performers, right? So you have the Russell 1000 Growth, ETF, IWF, and also the SPDR or SPDR S&P 500 ETF, ticker SPY. Both of those ranking really well compared to their category. When you're talking about the Russell 1000 Growth in the top decile on the 10-year rank, and then the S&P 500, the 12th percentile on the 10-year rank. Pretty impressive. And I think most people would look at this and say, active managers aren't doing so well against those benchmarks.
Yeah, and both of those are the benchmarks, meaning passive. So we want to take a step back there and kind of explain the difference between passive versus active really quickly, just to make sure everyone's kind of on the same page there.
Sure. Yeah, go ahead, Arish.
Yeah, so the difference between passive and active managers. So passive is basically just going to be the benchmark. There's not someone there managing this pool of investments. So let's talk about the S&P 500. When people think about stocks, they often think about large cap US equity stocks. And so the passive benchmark for that would be the S&P 500. There's nobody that is out there determining, hey, do we want to include this stock in the SPY or not include it? There's some rules-based formulas usually that determine whether a stock is going to be in that passive index or not. So for the S&P 500, it's based off market cap, the top 500 biggest market cap companies in the US are included in the S&P 500, and that makes up the benchmark. But for active managers, it is where there is someone who is managing this portfolio. So if, let's say there's going to be a different active manager for each type of sector in the market. And so compared to the S&P 500, you can have an active manager who's trying to compete against that benchmark of the S&P 500, like you mentioned. And so they're going to be purchasing large cap companies. They're going to be looking at different metrics. They'll have a team of analysts determining whether a stock is undervalued or overvalued, and they all have their own specific metrics that they're looking at. So one active manager will be looking at valuation, for example. Another will be looking at growth metrics, and they all kind of have their internal things that they're looking at, and they're all very different. But the grunt of kind of the difference is active managers, you're paying for someone to manage that portfolio and be selecting these stocks, versus a passive index is just kind of this rules-based formula to determine a benchmark of these stocks. How'd I do? How was that?
Nailed it. Yeah. I think, the easy way I always say is a passive index is kind of like putting it on autopilot, right? We don't really care which stocks we own. If it's the top 500 stocks and they happen to be profitable, then they're going to get thrown into the S&P, and then you're taking a shotgun approach and you're just buying all of them, right? An active manager is going to be a lot more particular. They're going to pinpoint the certain stocks that they want, like you said, based on valuation, based on earnings growth, et cetera. And you would hope that those active managers can add value by either one, choosing the companies that do the best, or two, avoiding the companies that do the worst, right? So that's a great thing. Thanks for making sure our listeners understand the difference there, because I definitely just jumped the gun and assuming that. I do that all the time. Thanks for keeping me in check. So, of course, if we go back to our list there, Russell 1000 Growth and the S&P 500 are both benchmarks or passive indices that have outperformed the active managers within their category. I think that what's interesting about this is that both of these benchmarks are very concentrated in pretty big tech stocks that have done really, really well, right? So take the Russell 1000 Growth, for instance. 25% of this index is in Microsoft and Apple. They're basically 12.5% each. So every dollar that flows in there, a quarter is going into Microsoft and Apple stock. When Microsoft and Apple do really well in the market, like they did last year, then it's going to be really tough to outperform that benchmark, because I don't know a lot of active managers that are willing to go overweight a position that's already 12.5% of their benchmark, right? And the S&P is very similar. Microsoft and Apple are, I think, closer to 13% of the total. The top 10 are close to 33% of the total S&P 500. So it gets really difficult to outperform some of these indices if the top names that are all mega cap names that are already very high weights have really, really, really strong years. And then to add insult to injury, all the other stocks in the indices basically did nothing. So there was really no way for active managers to keep up over the last couple of years. But even then, you look at this chart, over the last 10, 15 years, active managers have been struggling in these areas, large cap specifically.
Yeah, no, those are great points there. And I know there's always an argument within the financial community. Okay, active versus passive. Oh, active's going to kill this year because of this, that, or the other. Or passive has this edge here. And so I know all of the listeners are dying to know now if do we lean on the side of active management or passive management? And I think the answer there is that we have both. We have that option for all of our clients, and wanted to kind of talk about how we provide value and how we kind of get our clients exposure if we want to get them active exposure, if we want to get them passive exposure, and how we do that in our clients' portfolios.
Yeah, I mean, we have options for both. Like you said, we try to be very flexible and allow clients to kind of choose what they want within the parameters where, we think they're not going to shoot themselves in the foot. They have appropriate asset allocation and the whatnot. I think the important thing to consider with active versus passive, number one is, and this is a big one for a lot of people, the cost. The internal management fees for some of these passive ETFs are 3-4 basis points, right? 0.0004% would be 4 basis points. That's pretty affordable compared to some of the active managers that are charging probably close to 70, 80, or even 90 basis points, right? So I think that's one thing. And then, of course, any active manager that's going to charge that fee has to make up that amount before they even can think to beat the benchmark, right? So they have to earn back their fee plus some in order to add value. So I think that's pretty tough for a lot of people, but there are people like me personally that think active managers can add value. And then if you find the right active managers that are consistent, that they have a certain approach that seems to consistently extract alpha from the market, then you should be investing in those areas. I know I have some personal assets and active portfolios. We certainly advise clients for their IRA or Roth money, so they don't have to worry about taxes. That mutual funds with active managers are a good way to go. But if you're in like a taxable account, you really just want your money to build up, and you don't want there to be a lot of costs or taxes associated with that. Passive could be the way to go for you.
Yeah, definitely. And I think one thing that we do really well in our portfolios for clients and how we structure a client's portfolio given their individual circumstance is always going to be different. But I think we do a good job of determining how much allocation we want to have to the different sectors of the economy. If you just selecting active or passive isn't going to determine how much you're going to have in large cap, for example, versus international versus fixed income. And so those are decisions that we're making internally for our clients based off their personal decisions or their personal situation, and saying, okay, we want to have this much exposure to large cap equities in the US. And we're basing that off of many different factors that are going on in the macroeconomy and what we're seeing going forward, and how much exposure we want to have to all of these different asset classes. And then within that, if we're selecting an active allocation, okay, with that international, how do we find the best manager who we think is going to outperform the benchmark in that category? For passive, okay, what's the best benchmark that we want to have at the lowest cost to get that same international exposure? And so that's kind of the big difference there in terms of how we do it internally. And I think that's a great way to kind of do it for anyone's asset allocation.
Yeah. I think those are great points. And, another one that I would mention here is that when you look at this list, right, of different ETFs compared to their categories, their active managers, there's a few that stand out here that clearly the active managers do add value, right? And I think it's very interesting to consider, some of those sectors, specifically looking at small caps or the Russell 2000, or even, mid caps over the past 3 and 5 year period. And then emerging markets as well. All of these are areas that the benchmark has been outperformed by the active managers, or put another way, investors are better off paying a little more for an active manager to go into these portions of the equity market and extract the stocks that they think are going to be the best performing. And historically, they've been able to do that. And one thing that I'll point out, even within some of our active leaning allocations that we recommend to clients, even within those, we use passive large cap indices because it's better off, right? If active managers can't out earn their management fee, then there's really no reason for us to allocate to them.
Definitely. And I think one thing that kind of explained it well to me in terms of when to use active versus passive, and kind of explaining the difference. When you think about just kind of a share price of a stock, it's the underlying fundamentals are based off of the earnings and how the company is doing, but the price is based off of what the market thinks that company is going to do going forward, which is then based off of the fundamentals of the company. And so what the market thinks is based off of these analysts who are reviewing these companies, and providing this guidance to their bigger company or the overall market with retail investors as well. And so if you think about a company like Apple or Facebook, there are so many analysts that cover each of these companies, each of these massive companies. And so the movement of it is really just kind of based off of the fundamentals of the company and kind of the overall basis. For these smaller companies, these analysts, there's not as many analysts covering, I can't even name a small cap company, but
Supermicro. I mean, it's a company that went from like 200 to 1100. It was in the small cap.
There you go. There's a lot less analysts covering it. Yeah, CrowdStrike. Yeah. A lot less analysts covering it. So if an active manager sees a lot of value that might not be shown in the stock price, they might hold it where an index wouldn't. And that would kind of give you that advantage. And on the alternative, they might see a company that shouldn't be held when an index would hold it, and they wouldn't have that in their portfolio. So I think that kind of shows to the testament of when to sometimes allocate to an active portfolio in different asset classes.
Yeah. I mean, I completely agree.
Sounds good. All right. Well, if we didn't bore you with active versus passive, we're going to switch to another topic. I think that is a good transition to kind of compare assets that you have managed either with us or with an investment manager separate from your employer. When you're kind of looking at your 401k and comparing it to your assets that you might have at Charles Schwab or Vanguard or whatever it might be. And you just kind of say, oh, my 401k was up 22% last year, but my other account was up 14% this year. And I think people kind of just look at performance and they just kind of say, okay, this is the end all be all. This account's outperforming this account. Why am I not having that same performance? I know I'm paying for this investment management. Why is it underperforming? I think the biggest thing comes down to risk versus return. We need to look at how you're allocated in each of these accounts. So when we're allocating client portfolios, we want to allocate this to the amount of risk that you're willing to take and that you need to take to achieve your goals, depending on your different type of account, or we might take different risk and have different return there. But in a 401k, you're typically just going to be putting that money into a target date fund, or something like that. And so a lot of times I've seen that in bull runs or good periods of the market, like 2023, a 401k might outperform their investment manager because they might be taking on way more risk in that account. They might be 80% in stocks in their 401k, but in their investment management account, when they talked about where they're at risk-wise, they said, okay, maybe I only want to have 50% in stocks. If stocks do really well, you're not going to have that same growth. Even though you have an investment manager reviewing it, you have 50% of that allocation in fixed income or in more stable areas of the market. On the contrary, if there was to be a market turn down, and I'm going to keep 2022 as an exception because it was one of the years, I know we've talked about it in a previous year, in a previous podcast, but one of the years where both equities and bonds went down kind of in tandem. But usually that fixed income exposure, if you're taking on less risk, is going to provide you less volatility and less downside. And so that's kind of the other side of the token as well. And so I think it's just something I wanted to talk about, as it's kind of become like an end all be all. You have two different accounts. You just look at the performance. This one's up this much. This one's up that much. All right, we need to take a step back and say, okay, why is that? The answer, I don't think, honestly, is always just, okay, your investment manager's not doing a great job. It's okay, maybe you might be taking more risk in that 401k versus the investment manager, and vice versa. So it goes both ways. Am I biased
if I weigh in on this, since I'm the investment manager?
Please weigh in. Please weigh in.
No, so I think it's really important to bring up risk, right? Because risk is really how you get paid in financial markets. So if you have a 401k that's 100% stock, and you have a different account that's, let's say, like 50-50 stocks and bonds, well, they're not taking the same risk. So you can't really expect them to have the same return. And over a long period of time, let's say 3 to 5 years, you would expect the account that has the most risk to do the best return-wise, because otherwise investors wouldn't be buying that risky security, right? Those risky securities have to keep providing that higher and higher return to the investors to entice them to take additional risk, right? So if you're not even taking that risk to begin with in some of the accounts, it's a bit like apples and oranges, and you can't really compare the two. I think about like this analogy. You're sitting at a stoplight. You're in a Honda Civic, right? A beater, maybe it's like a 2000, okay, 4-cylinder. And then some guy pulls up beside you in a brand new supercharged Corvette. And he's like, yo, let's race. Okay. Y'all race. Okay. He whoops your butt. You get to the end of the finish line and he's like, you see that? I'm a better driver than you. I don't know. I don't know if that would be my conclusion, right? I think really what happened is he's got a super turbocharged car. If he hits a puddle, he's got a lot more risk on his side too. Right. And so I think we have to remember the kind of risk to take, the kind of car that we're in, right? And the kind of speeds that it'll go, and, you know, the purpose of the assets that we're investing in. A lot of clients that are not happy with some of their fixed income returns, or the fact that some of their portfolios have been in some of these safer, less volatile assets, I think would be happier if the market didn't turn out the way it did. Right. And you have to remember that, you know, years like we had last year, the market, They don't happen every year, and we don't know when the next year of reckoning is, right? And so you want to make sure that you have all those risk parameters in place up front, and then you have to be happy with it, and then you got to stick with it.
I love that analogy, Jeff, and I'm definitely going to steal that and use that for some of my clients. I think that's a great explanation. If there's a pothole, you probably don't want to be in the Corvette. I think the Civic's going to win, so...
Yeah, that's right. That's right. If you're going up to the mountains, you don't want to be driving a Corvette. You know, I mean, sometimes you got rocky terrain ahead, and you want something a little more stable. You know, and so let's make sure we're comparing apples to oranges there, and just remember, you know, if you're earning more return somewhere, it's probably because you're taking more risk. That's just generally the rule.
And one thing with risk versus return, I mean, you alluded to it and basically said it, but if you are taking on more risk, you have more exposure, you want to be compensated for that with more return potential. And I think it's such a fundamental of financial markets and investing. And it's so important. And it's kind of inherent with stocks versus bonds, but I think it's something that kind of gets overlooked when people think of outside investment opportunities for their business or for private equity or for whatever it might be. Say, okay, I can put this much into this business, but it could go to zero. But if all goes well, I'll get this % return. Okay, if it can all go to zero and your only upside potential is 5% a year, that's probably not a great investment. You're not getting compensated for that amount of risk that you're taking there. Where, I mean, if you take that same risk in a diversified portfolio in stocks, we have a higher upside potential on an annual basis. Without that same ability for it to really go to zero if we're well diversified.
I like how you said potential. I think that's like a really good way to think about it. Yeah, it's the return potential, you know, and
exactly.
There's a lot of different ways in financial markets to take a little bit more risk to try to get a little bit more return, right? But I think the important part is it really always is the potential. And that's something that I think clients can miss. If they see the returns of the past few years, they see returns over 3-5 years, and they think, okay, well, this is just going to happen again. It's very easy. I'll just put my money in there and I'm going to get these returns. Well, no, your money is at risk. I mean, these things go up and down all the time, and they typically recover, and they typically make a lot of money over, 3, 5, 10-year periods. but it's always a return potential and never a guaranteed return, unfortunately.
Yeah, I just kind of thought about this on the fly with risk versus return, but I don't know how I just remember this, but this was like a health teacher in 9th grade who was talking to us about risk versus return and said, okay, is it worth it for you to skip class and go watch a movie and potentially get suspended and then not get that scholarship you want to have watched this movie? So is the amount of risk that you're taking equal for that return? And was kind of just trying to hammer that point in. But I mean, it's the same thing with all of life and all of financial markets and all kind of business decisions, all the same with how much risk you're taking. The more risk you're taking, the more you want to be compensated with that potential return. So I think that's a good point to make there. I think we have time for one last category, so I'll let you choose.
Oh, okay. One last one. Well, I guess we're going to pick an investment topic then. Let's talk about the Fed. So I have this graph in here. This is from Guggenheim, I believe. And they put together different asset class performance, looking at different Fed policy cycle regimes, right? Is the Fed tightening policy? Is the Fed holding interest rates steady, or are they pausing, or are they easing policy? They're cutting rates. Yep. And this has really gotten a lot of attention lately because obviously the Fed just concluded, or most people think it's concluded, a pretty severe tightening cycle, right? Interest rates went from 0 to now they're 5.5%. Not only is that some of the highest magnitude amount of rate hikes the Fed has ever done, but they did it really in a matter of a year and a half, right? They did it really quickly. And so a lot of people now, the conversation has shifted to, when are we getting the cuts, right? We got to normalize interest rates. And I think that's 100% fair. We definitely have to normalize interest rates, but there's a lot of talk about, is it going to be 7 cuts, 8 cuts? You know, you got people like rubbing their hands together. They can't wait to get all their cuts. And I'm sitting here thinking, like, is it really better if the Fed cuts rates? Because doesn't the Fed usually cut rates when something starts to go wrong? Like it's not, cutting rates from the Fed's perspective is really doing damage control and applying a Band-Aid, right? And you don't want the Fed to be doing damage control. So I really thought this chart was interesting from Guggenheim, because what it shows is that when we're in a pause cycle, which is what we've been in since the last Fed rate hike last year, when we're in a pause, that's whenever financial market returns are the highest. The S&P is averaging almost 20%. Bonds are averaging over 10%. Looks like about 12 there. High yield, just under 10%. Even money markets looking at 5% in a pause, right? That all looks pretty good. In a tightening cycle, the returns are a little lower, right? The S&P is looking at just about 7. U.S. aggregates about flat. Investment grade corporate bonds about flat. ABS, high yield, all about the same, right? But how about an ease? An ease is when the Federal Reserve is cutting rates. Higher interest rates have been something that's been holding back financial assets. So surely the Fed cutting rates is good. Well, interestingly enough, the Fed easing rates is good for investment grade corporate bonds, for the bond market overall, the aggregate bond index, asset-backed securities, but not high yield, not leveraged loans, and not the S&P 500. Why do you think that is? What do all those sectors have in common? Or I should say,
is that hypothetical? Or are you asking
me? I'm asking you. Like, well, what do you think? I mean, brainstorm here with me. If the Fed
is on the S&P 500, just thinking about the S&P 500 when the Fed is easing, the only thing that would make sense to me there is that those rate cuts have already been priced into kind of the market, and then once they finally accumulate and start happening, maybe it's not as drastic as expected, and then that could be why we see that negative return there.
I think that's part of it, right? Like okay. we're pulling forward some of those returns into the pause phase, right? Mm-hmm. Because the market is anticipating these rate cuts, and
sure.
Ceteris paribus, rate cuts do seem good. Interest rates go down, discount rates go down, present values go up. Present values are prices. That all seems to make sense. But typically, things don't happen in a vacuum. The economy is a complicated place. And if the Fed is cutting rates, that means something in the economy is gone wrong. And if there's something that the S&P 500 or high yield bond index or the leveraged loan index, if there's something all of these asset classes need, it's good economic health. because these are very cyclical asset classes in the economy. These are some of the riskiest securities that really you can invest in. And so whenever you have the economy start to fall apart, which tells the Fed it needs to drastically cut rates, right? Start doing damage control. Then you have some other cyclical assets join, such as leveraged loans and high yield, that typically see their credit spreads widen out a lot, which is another way of saying investors are requiring higher and higher yields to be compensated for the higher risk there, right? So I think it's a nice cautionary tale to remind investors, number one, we're in a pause phase right now. And the reason why the Fed's not cutting rates is because the economy is actually pretty strong. Now, we know inflation's not down to 2% like we want. The CPI report came out this morning, certainly not making a ton of progress there, kind of stuck at 3, but the economy is not falling off a cliff. So the Fed doesn't have to cut, right? So we're in a good place right now. I would actually caution investors against wanting those cuts, because what's going to happen is if we have a lot of cuts, that usually means we're in a bad place for the economy. If we can get 2 or 3 cuts like the Fed expects, that probably means that the economy is holding up well and they really are just normalizing policy. I think that is good news for stocks and bonds.
So is Jerome Powell, Fed chairman, just waiting for something to break before we finally see a rate cut? Or,
you know what? I don't think so. I think the Fed is actually pretty in tune to this, right? They can't say it to the market. They can't say hey, well, we're worried about the economy, so we're going to start cutting rates first before inflation gets to 2. But what they will say is we're in a restrictive rate territory that is no longer justified given the inflation environment. And that's going to give them the ability to kind of squeeze in some of those rate cuts even without the economy falling off a cliff. So I think we're getting there. I think the market is aware of that. And actually, if you think about economic health, decreasing interest rates is actually better for investment opportunities, CapEx, and some of these small and mid-sized companies that rely heavier on debt financing, which is more expensive for them. So I think there's a lot to be excited for. And if clients can remember anything from this conversation, it's active does work sometimes, and the Fed cutting rates isn't always good.
There you go. Great conclusion there. And I thought that was a great discussion kind of on the Federal Reserve and interest rates in general. The Fed's reason for being in kind of the banking system is to stimulate our economy when it needs to be stimulated and slow it down when it needs to be slowed down. And so when we had these really high inflation, we needed to slow the economy down because we needed to bring prices down. We couldn't let this inflation get sticky and stay into the economy. And the Federal Reserve realized that, not immediately, but then they did, and increased these interest rates like we saw. And like you mentioned, nothing is broken yet. And so that's why we haven't brought these interest rates back down. The interest rate or the inflation has moderated. We're still around that 3% range. And so we're still kind of waiting for it to tick down a little bit more. But these interest rates, I know on 2 episodes ago, we talked a little bit about higher than normal and what the Fed's goal is. And so that, like you mentioned, can be one of the reasons they look to decrease these rates. But I think that's really good discussion around kind of what makes the Federal Reserve tick and how that affects the rest of the economy. So
I think one more point on that, Arish, I think is interesting is the Fed is one of the only central banks in the world that has a dual mandate. Okay, it exists to accomplish 2 missions: price stability and full employment. All the other central banks, it's just about price stability, right? So the Fed actually has written into the legislation that created them that they have to consider the economic health of some of their policies, and that gives them a lot of wiggle room in order to kind of cut rates before maybe we hit inflation target, which is pretty much what Powell's been telling us. So stay tuned. It looks like the market's pricing in June or July. We'll see.
Yeah, and June or July as the rate cut there is what Jeff's referring to. And we'll have that graph that we just mentioned on the screen on the YouTube. Again, to pull that up, just look up Beam Wealth Advisors on YouTube or Benedetti Gooser and Associates, and you'll be able to pull that up. But Jeff, thanks as always for giving your insights, great analogies, ones I'm definitely going to have to steal in there. And thank you to the listener for tuning in.
Thanks for having me.
All information provided by this presentation is for educational purposes only and does not constitute investment, legal, or tax advice. It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third party's views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside of Benedetti Gooser & Associates and Beam Wealth Advisors. All examples are hypothetical and for illustrative purposes only. Benedetti Gooser & Associates and Beam Wealth Advisors do not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.